I think the broader crypto space is basically out of narratives. So other than Bitcoin and stable coins, at a macro scale, there's really no there. I've been a gold bull, but I'm surprised as well that it hit 4,000 this year. I didn't think you'd kind of just race right to 4,000. Ever since 2009, you've had a gradual shift towards sovereign reaccumulation of gold. If a sovereign is holding their and securities of another nation, they're not really sovereign assets. Outside of AI, the stock market is pretty flattish. And so it's not a very risk on environment, even though liquidity is good. Quite structurally bullish on Bitcoin. I do expect that, in 2026, we'll be back into the six figures. I mean, anything can happen between now and year end. And whether it's 2026 or 2027, I think we'll be seeing new all-time highs, most likely.
In today's video, Lyn Alden breaks down the shifting macro landscape and why both gold and Bitcoin are reacting the way they are. She explains that even with equities near highs, the broader economy is flat, pushing investors toward assets viewed as more reliable stores of value. Lyn highlights a major long-term trend. Since 2009, sovereigns have steadily rotated away from Treasuries and back into gold, a move that accelerated after 2022. That shift, combined with fiscal pressure and geopolitical risk, helped propel gold far faster than she expected, even breaking above $4,000. And while Bitcoin has cooled recently, Lyn still sees the longer-term path as higher, expecting it to return to six figures within the next major cycle. Before we continue, please like the video, subscribe, and turn on notifications so you never miss future market insights. Your support helps the channel reach more viewers. Enjoy the video.
I've been a gold bull, but I'm surprised as well that it hit 4,000 this year. When it was in when it still had a 2,000 handle on it, I was kind of eventually looking forward to the 3,000. But I didn't think you'd kind of just race right to 4,000. So I'm happy it did, but wouldn't have put it as my base case, especially given the size of the market. It's a huge kind of multi-trillion dollar market cap increase in it. There's multiple shifts happening. One is ever since 2009, you've had a gradual shift towards sovereign reaccumulation of gold. So prior to then, you had a multi-decade kind of divestment of gold among sovereigns and toward treasuries. Starting in 2009, that gradually reversed. It got kicked into overdrive in 2022 because then you have potential risk of confiscation or freezing of assets if a sovereign is holding their and securities of another nation, they're not really sovereign assets. And so there's kind of been a shift toward that. Then there's the increasing awareness of fiscal dominance and the increasing awareness that nothing stops this train, which says, well, if this is just going to happen for 5, 10, 15 years, maybe I want to own some gold. That's the one that's got an established track record. So big pools of capital already know what to do with it. They don't have to research it. They already know what gold is. And then in addition, this is not really, even though the stock market is near all-time high, it's because it's so narrow, it's mostly not even a risk-on environment. Like I mentioned before, we've been in an unusually long period of kind of like flat yield curve, PMIs, like purchasing managers indices of like manufacturing and other signs that are just kind of like in stagnation. Um, Outside of AI, the stock market is pretty flattish, kind of consolidating. And so it's not a very risk-on environment, even though liquidity is good. So when you have kind of pretty decent liquidity up until maybe very recently, and then you have kind of stagnating broader economy, the Fed still trying to tighten things where it can. The things that have taken off has been AI, gold, like kind of what the market ironically looks as low risk. They view AI as low risk, even though the pockets of it that are obviously not, but they view it as low risk because they view it as like a sure thing. It's like,
Mm-hmm.
okay, that's cycle resistant. Let's go to AI. Then they say gold, okay, that's low risk. Bitcoin, until pretty recently, was in that bucket, where it's benefiting from liquidity, from kind of gradual adoption. But as you have kind of like a flattish environment, Bitcoin cooled off. So I think basically gold's behaving kind of, rationally, just a little bit, these things tend to not be linear. So you tend to overshoot to the upside, then overshoot to the downside, then overshoot to the upside. So this did overshoot to the upside faster than I would have thought, but I think it's a gradual realignment for things we've talked about in prior podcasts, a more multipolar world, less kind of a focus on every country just holding one country's bonds as the reserve asset and saying, okay, we'll hold those, but we also want to hold these other, say, three things. We want to hold gold, maybe we want to hold another trading partner's currency around the margins. Smaller ones might say, well, let's look at Bitcoin a little bit. You get that kind of gradual broadening of assets that are viewed as kind of reserve assets. And gold, as the incumbent, is kind of been the chief beneficiary when we're talking about the market's being increasingly spooked about these tens of trillions of dollars of sovereign debt. So whether it's the US, it's Europe, it's elsewhere, the market is kind of long term says, okay, what's the end game here? And you have gold, which is a much smaller market despite being huge than those sovereign bonds. It only takes a small gradual spillover for investors to start kind of going into gold. They don't have to do a ton of research because they know what gold is.
Yeah, one of the things that I found really interesting is the kind of retail FOMO around gold. Because as we were saying earlier in the show, there's really not been a huge influx of new retail participants in Bitcoin. But I don't know if you saw the pictures going around Twitter and stuff of people literally queuing on the street outside gold shops. I think they were actually here in Australia.
Yeah.
Has that surprised you? And like one of the things we talk about often in Bitcoin is like the unit bias. Obviously, the unit bias for gold is lower, but as a market, it's huge compared to Bitcoin.
So the short answer is it hasn't surprised me because so back when gold was like 3,000, one of the interesting things at the time was that it was not retail driving it. So when you looked at like interest in gold ETFs or interest in physical coinage, it was kind of lukewarm. Whereas the price was going up anyway, and it was because sovereigns and institutions were driving it. It was kind of like gold's moment of like the treasury company thing, right? It's like big pools were interested in it. China and India were interested, so their retail was interested. But kind of the Western retail was like other things are going on. When the Mag 7 was soaring, no one's like they're like, yeah, gold's okay, but I'm not really interested in it. It's only really in kind of the second half of this year where Western retail did start to FOMO into gold. So that's kind of a later stage portion of it. So first institutional, then retail, and that's generally how things go. So if anything, if you'd asked me last year, I'm surprised there's not a little bit more retail FOMO than there is right now. But then I would also not have guessed you gotten to 4,000. But when you do get to 4,000, I'm not surprised that, yeah, you start seeing lines outside of gold stores, either to buy it or sell it, because actually both tends to happen. There are people that need money and have, a gold ring and they want to go sell it. And there are other people that are then FOMOing into it, is how these things tend to go. Um, and if Bitcoin can have a cycle like that, where if you break the 4-year cycle, you have an up year, institutions are positioned and it starts to rip, you can bring in retail. So it's like just because retail's not here now doesn't mean they can't come later. And unfortunately, retail tends to be kind of the later phase of a given bull run. Now, but I think I view gold in a similar way that I would view AI, which is that it can get into a local bubble, but that I still think it's structurally fine. The last time I gave a warning of that sort was back in 2020. Gold, of course, had a very big moment. And I was like, I could see it taking a breather here. It took a little longer breather than I thought, but then it did this whole kind of next doubling that it did. Um, and I view it kind of similarly, which is sure it's over its skis right now. But I don't view it as like structurally overvalued. If anything, it's going from being just kind of structurally undervalued to like back closer to like what I think makes sense. And so, yeah, I just view gold and Bitcoin as kind of two different assets. Gold still, because it's the incumbent, it has more of a risk off aspect to it. It's got more of a sovereign interest in it. Whereas Bitcoin is still kind of collectively lumped into a tech play, even though from those that deeply understand it, it does have, digital gold, digital cash attributes that can be viewed as risk off as well. Just the price action tends to correlate more with a risk on type asset.
That makes sense. Okay, Lyn, last question. Bitcoin's just above 90,000 now. I'm not asking for a price prediction here, but just like directionally over the next 12 months, what do you think? How are you looking at Bitcoin?
My guess is up. I don't have a view of the next quarter. Um, I've I always do try to avoid price predictions when I get quartered into one. Like for 2025, I was like, yeah, anything under like if we don't hit 150, be a little disappointing. Of course, we only got to like 125 or so it's on the disappointing end. Um, I do expect that, in 2026 we'll be back into the six figures. I mean, anything can happen between now and year end. Um, And whether it's 2026 or 2027, I think we'll be seeing new all-time highs, most likely. Um, and it's funny when because I watch Twitter sentiment, when Bitcoin is absolutely soaring, I get sometimes dunked on by Bitcoiners saying, "Why do you own any gold? Why do you own any stocks? Why aren't you 100% Bitcoin?" And it's like, well, because I like some degree of diversification here. And then when Bitcoin's crashing, I get the gold bugs coming out and saying, "Oh, like, they should just own all gold." Or like, "Why do you own any Bitcoin at all?" And it's like funny how that emotional trend goes. And one of the ways is to say, okay, well, you don't want to diversify so that you own a little bit of everything. You still want to have opinions on assets, and you can make concentrated bets. I mean, I'm quite structurally bullish on Bitcoin, for example. But that's also why I own gold and I own equities that have nothing to do with Bitcoin, because there are different size markets, different performance kind of patterns that they go through. And then for me, it's not just about owning what I think is going to be the fastest horse. It's okay, I'll put extra on the fastest horse, but I want to own a handful of horses.
Hmm.
And so when you structure a portfolio like this, it's like, well, okay, I'm disappointed in Bitcoin this year, um, but I'm enthused by what gold did. Um, and if you structure a portfolio that way, you take the edge off for a lot of these things. And so, I think we'll see a rotation at some point. Where I'll be disappointed in the gold side of my portfolio, and I'll be enthused about the Bitcoin side, and then probably it'll repeat again. So, yeah, nothing's really changed around my view of any of these assets. It's just they catch on at different speeds and they have different correlations. And like I said before, I think that a year ago or 6 months ago, some percentage of people bought Bitcoin for maybe the wrong reason. That
Hmm.
they bought it because they think Uncle Sam's going to buy it, rather than buying it for its own qualities and kind of the longer term story of what it is and what it changes. In addition, I think the broader crypto space is basically out of narratives. Um, and that's basically dead weight now. So other than Bitcoin and stable coins, a couple small tech rails to run that kind of stuff. At a macro scale, there's really no there in the broader crypto space. And so I think that that's part of why kind of the whole space is bearish, because a lot of people that own Bitcoin own other assets, and they view it as not just a bad cycle, but that there's just what's the next narrative. You had ICOs, you had NFTs, you had DeFi, you had meme coins, which is basically the most cynical narrative, is saying that we're just flat out saying there's no there. Then even that kind of eventually rolls over, and there's really no kind of you can always be surprised by another one kind of coming out of the hat, but I think a lot of that has kind of tested almost every directional narrative that it could, um, and is kind of set for structural stagnation. So Bitcoin has to kind of decouple from that dead weight to the extent that it's going to keep kind of reaching higher highs.
A key takeaway from Lyn Alden's analysis is that gold's surge and Bitcoin's consolidation reflect deeper structural forces, not short-term hype. Since 2009, sovereign capital has gradually rotated away from treasuries and back into gold. A shift accelerated after 2022 as geopolitical and fiscal risks grew. Alden sees Bitcoin benefiting from similar dynamics, even if the broader crypto space has run out of narratives. While pullbacks are normal, she still expects Bitcoin to push back into six figures over the next major cycle as it continues maturing into a true monetary asset. If you're enjoying the analysis, be sure to like the video, subscribe, and turn on notifications for future market insights.